Welcome back. Now, at the half-year mark, a lower impairment charge paired with tight cost control measures and a 7% growth in non-interest revenue has led to an 8% rise in Nedbank's headline earnings. Shareholders walk away with an interim dividend of nearly 10 Rand. That's up by 11.5%. Joining us for greater perspective on the performance is company CFO Mike Davies. Thank you so much for your time, Mike. Now, the stars are aligned. The share price move today is the color of Nedbank. Just frame that performance that investors have reacted positively to.
Yeah, so obviously very chuffed with a strong financial performance for the group for the first half of 2024, with headline earnings up 8%. And when you take into account the buyback we executed last year, DHEPS up 12%. So a really strong financial performance. And that has supported a dividend of 9.71, as you referred to, up 11.5%. So I think shareholders will certainly be pleased with that dividend.
Yeah. Well, talk to me about the dynamics and I guess level of growth between your non-interest revenue and your net interest revenue in this kind of environment.
Yeah, so what we experienced was certainly slower balance sheet growth than we had expected. So loans and advances were certainly slower. And I think you'll see that across the market, not just Nedbank. And that really talks to an environment where interest rates have remained higher for longer, inflation has proven to be sticky, and as a result, consumers are feeling the pressure of those higher debt service costs. So they've been cautious in terms of whether or not to take on further debt. We've also seen corporate South Africa waiting for the elections to move through, and obviously post the election, I think we're likely to see stronger balance sheet growth in the second half of the year. But that has certainly resulted in softer net interest income in the first half. And then that's been compensated for by stronger non-interest revenue experienced in the first half of this year. And it really points to stronger commission and fee growth. It points to a stronger trading performance that has boosted our non-interest revenue. So certainly softer on the NII side, but certainly a stronger performance on the NIR side.
Softer loans and advances, does that mean that it lends itself then to the lower credit loss ratio and the lower impairment charge, or what is that exactly a function of?
It's a function of two things. One is that consumers have certainly gotten used to a tougher macroeconomic environment. So obviously the rate hiking cycle was behind us before moving into the first half of this year. And that certainly has helped. We've also put a lot of resources behind collections. So in other words, managing the back book in terms of the bad debt position of the organization. And then we've been very selective in terms of front book origination. So we've been very cautious in growing the unsecured lending part of our portfolio. We've seen growth in the secured books versus the unsecured books. And then we've resolved some large counters in the corporate space that are certainly public names familiar to most.
So would you say maybe that's more of a function of the interventions that the bank has implemented that are paying off, rather than maybe a consumer that is in a better position in this environment?
I think it is. It's certainly back to the collections efforts we've put, particularly in the consumer parts of our business. But I think it does talk to the consumer being a lot more responsible and cautious, given the fact that we haven't seen inflation come down as quickly as we had expected. And as a result, we haven't seen the start of an interest rate cutting cycle that we are expecting in September of this year.
Yeah. Well, what was quite interesting also is that Nedbank has boasted some market share gains in a number of areas. Talk to me about that, and also really the levers that you've had to pull there.
Yeah, so we've seen gains in areas that we wanted to grow. So we've seen market share gains in the vehicle finance portfolio, a portfolio that we've got a very strong position in the market. We've seen some gains in the home loans market, again, an area that we are looking to grow market share. We've seen or saw gains in retail deposits, again, an attractive space for us to grow share. And then you would have seen on the opposing side of that, we've lost some share in unsecured lending, again, as a result of deliberate strategies as it relates to being cautious at this point in the cycle.
You talk about also corporate lending that was also softer, but also really seeming that there will be a pickup in activity after the election uncertainty. Are there any signs of where appetite is going to be, when it comes to corporates and maybe hoping for a better operating environment there?
So we certainly are expecting a stronger second half for a couple of reasons. One, obviously, the elections were peaceful. There's been a number of the retention of a number of important ministers. There's been some new appointments. I think you've certainly seen the market respond favorably to effectively the positioning of a government of national unity. So I think all of that will play out positively in the second half. But again, we are cautiously optimistic. And then secondly, we are seeing, a lot of corporates look to, again, deploy balance sheet into renewable energy alternatives, particularly supporting their businesses. So we do expect ongoing growth in renewable energy opportunities and/or opportunities further into other infrastructure projects, and/or we are seeing some growth in our mining clients. So certainly are opportunities in the second half of this year.
All right. Just lastly, as we wrap up with the conversation, Mike, I think we have about 30 seconds. Of course, it is now the second half of the year where there's a lot of anticipation for interest rate cuts, of course, something that the banks have benefited from. But of course, now you even mentioned that there was a softer net interest revenue on that front. How are you viewing, the interest rate cycle that is to come, and particularly maybe now with anticipation that even the Fed might come with more aggressive interest rate cuts with worries of a recession? Do you think that could filter through to here? How is the bank looking at that?
I certainly think that the Fed needs to cut first. So I think that's just the position we're in. We do believe, it is our house view, that we will see 25 basis point cuts in September, followed by a further 25 basis points in November. And then at this stage, we are expecting further cuts into 2025. But we do expect this cutting cycle to be reasonably shallow.
Okay. All right. Well, thank you so much for your time and really giving us more detail on the performance that Nedbank came out with in this interim period. That was Mike Davies, CFO of Nedbank.